Okay, hello, one and all, and welcome to our. I think this is day 5, if I got that right, on our review. Let me just see what I got here. Is this day 5? Yes, it is day 5, and happy day before Halloween. Okay, all right. Pity we don't have our class on Halloween itself, right? I would have come in a costume. Okay, all right. So again, we're going to keep reviewing our material here. We're going to focus a lot on practice questions, and this week we want to focus in on the um, things like the options, customer accounts, retirement accounts. So I've spent a little time here gathering and culling some practice questions. So we'll have the chance to go through them together, and I'll bring those up here momentarily. Hang on a moment, I'll grab that for you. Okay, I think you should see it right about now. Are you able to see it okay? All right, getting virtual thumbs up all over. Okay, great. All right, question number 1 again. Just type what you think is the best answer in the chat on your control panel. Question number 1, or first question is: the premium on a call or put option is the A, exercise price of the contract; B, the cost of the contract; C, the marketing price of the underlying instrument, or market price of the underlying instrument; or D, cost of the underlying instrument. What do you think is the best choice? Okay, let me see. I've got 1, 2, 3, 4, 5, 6, 7. Okay, I think everyone's answered. So let's take a look. So the best answer choice, the premium on a call or put option is the cost of the contract. Yes, yes. The premium is the price that the option buyer pays and the option seller receives in their contract to basically trade at the pre-agreed price. Option buyer pays the premium, right, for the right to exercise it, the right to trade 100 shares of stock at the strike price or exercise price. The option seller, however, in exchange for the money received, right, has agreed that they would trade at the fixed price if the option buyer wants them to do that. So, okay, so that is the cost of the contract. Now, the exercise price is the pre-agreed strike price of the option, which, of course, if the actual market price, right, makes it valuable, right, makes the option valuable to trade it, then of course the option buyer will exercise the option. All right, our next question is: which contract will likely have the highest premium when ABC closes at $38? A, ABC January 35 call; B, ABC January 35 put; C, ABC January 40 call; D, ABC January 30 put. Okay, I think everyone's answered. So the question here is: which contract will likely have the highest premium when ABC closes at 38? Now, if you remember, the premium, right, the premium is made up of two things. The premium is made up of the intrinsic value plus the time value. Now, time value is how much time is remaining until the option expires, right? Because it's only good for a limited time. So the more time there is, the more valuable it is, more time value. All 4 of these options expire in January. So therefore, they all have the same time value. The difference then would be its intrinsic value. Intrinsic value means like built-in profitability to it. Is the option profitable to use it or not? There's only one of these 4 has built-in intrinsic value to it. Can you tell me which one? And could you even tell me how much intrinsic value it has? Which one of these is inherently profitable if you compare the strike price versus the market price of $38? Well, let's take a look at choice A, okay, which is a January 35 call. That's the right to buy ABC stock at $35 a share. Now, could you make a profit buying something for $35 that's worth $38? You can make a little profit doing that, couldn't you? In fact, how much profit would you make? $3, right, Amy? Exactly. So the January 35 call has $3 of intrinsic value, $3 of built-in profitability to it. And they all have the same time value. Now, does any one others? How about choice B? That's the right to sell 35 ABC stock at 35 when it's worth 38. Would you be interested in selling a stock for $35 that's worth $38? Could you make a profit? Kind of hard to make a profit that way, isn't it? So choice B has no intrinsic value, right? It's out of the money. Choice C, the January 40 call, the right to buy ABC at $40. Would you be interested in paying $40 for something that's worth $38? Not too likely, is it? No, this option is also out of the money. How about the January 30 put? The right to sell ABC at $30 when it's worth $38. That's even deeper out of the money, isn't it? Even further out of the money. So B, C, and D, none of them have intrinsic value to it. The only one that does is the 35 call. And since they all have the same expiration date, they all have the same time value, but only choice A has any intrinsic value. Therefore, our best answer choice is indeed A. Okay. Now, is there any part of that doesn't feel totally clear? If you need extra help with that, please unmute, type something. Oh, you misunderstood the question. We have to be careful about that. Um, could you maybe tell me a little bit, and maybe it might be easier to unmute, but when you read the question, kind of what direction did you think it was going?
My understanding was you're paying $40 for something that is worth 38.
Uh-huh.
So you're paying $40 to have the option, and then it sells
okay.
at 38. So you're out the 40 plus it sold for
Okay.
cheaper than what? That was my
Okay.
understanding.
Okay. You might be we're looking at the strike price rather than the premium. To figure out the premium, you have the intrinsic value of the premium, compare the strike price of the option, right, which were 35, 35, 40, and 30, right? And compare that against the actual market price and just use those two numbers to see is there any intrinsic value to it. In that case, if the option has intrinsic value, then the option is in the money. Okay. All right. Thanks for sharing that, though. Okay. So that helps us, kind of figure out, how our thought process. Okay. Intrinsic value is defined as the A, excess of premium over the underlying securities market price. B, excess of time premium over the in the money amount. C, difference between the strike price and market price of the underlying security if exercise is profitable to the holder. Or D, maximum potential gain on the contract. Okay, I've counted 6. Okay, anyone else gonna answer a response? Okay, intrinsic value. Maybe it just helped that I described it a little bit here. Okay, but hey, if there's a little bit of help on it, but yes, correct. The intrinsic value, the difference between the strike price and market price, if it's profitable to use it, right? It's built-in profitability. That's what I mean by intrinsic value. Very nicely done. That's our next one. To establish a long put position, an order ticket must be marked. A, opening purchase. B, opening sale. C, closing purchase. D, closing sale. If you're not sure, well, yeah, this is all practice, so just give it your best guess. Look at the clues, look at the information you're given. Try to eliminate anything that doesn't, that's totally out of. Okay, 1, 2, 3, 4. Okay, Amy, you want to give it just a shot? Just hey, you got a 1 in 4 chance if nothing else, right? And maybe more if you can eliminate some of them. Okay, you can change your answer, no problem. Okay, all right. So to establish, well, first off, it says establish. So to establish something, of course, that means something that would be something new in your portfolio. So in that case, if it's something new, if you're establishing something, it has to be an opening transaction. Whereas a closing transaction is when you get rid of something, when you get out of an investment. So we've just eliminated C and D. All right, to be long, remember what the phrase long means? In industry jargon, long means to own. So if someone buys an investment, they own right? We say they're long the investment. So in which case, to establish a long put position, since it's something they establish and something they own, the best answer choice would be A, an opening purchase. Okay. Had it been to establish a short put position, then B would have been the best choice. Right? That would be an opening sale. Because when someone is short, short means to owe, right? That creates a liability. When someone sells an option or writes an option contract, their first transaction is to sell something or an opening sale. Okay, now when you get out of the investment, then of course you close it out, closing position. So if you start with an opening purchase, you get out of that with a closing sale. If your first transaction was an opening sale, you get out from under that obligation with a closing purchase. How to recognize the perspective it's referring to, right? So first the part of the perspective was establish. So establish tells us we're creating a new investment here, right? Something for our portfolio. So that gives us an opening transaction. And the phrase long, again, that's industry jargon. Long means to own. So this would have to be an opening purchase. That's how we recognized it. Again, if I established to a short put position, then B would have been the choice, right? To opening sale. Okay. Does that help? Good deal. Thanks, Karina. If an equity put rider is exercised, the rider has the obligation to A, deliver cash in 1 business day. B, buy stock in 1 business day at the market price. C, buy stock in 2 business days at the market price. D, buy stock in 2 business days at the strike price. Okay. All right. Some difference of opinion here. 2, 3, 4, 5, 6. Okay. Kimberly chose day. D-E. Okay. Which, of course, in Spanish means of. So, okay. Misread the question. Hey, those two first, but it seems you caught it. Okay. So, right there, that's a good thing. Okay. Okay. I'm counting 6 answers. Okay. Okay. All right, very good. So if an equity put writer has exercised the writer has the obligation to, right? Okay, remember it's a contract and the option it's the option buyer or holder who has the rights and the option writer has the obligation. What is the obligation? So as a put writer, what do they have to do? Someone says, the holder says, I'm gonna use my contract, right? I'm gonna use my coupon. And I'm gonna sell this stock to you at the price we agreed, right? So it says it's an equity put. Equity means, well, the word equity means ownership, and ownership means stocks. So it says, right, a contract on 100 stocks. I'm going to sell my stock to you at the price we agreed. Since it's a contract, the person who gave them that option, the writer, has to buy the stock from them at the pre-agreed price, at the strike price. And yes, and it's a 2 business day settlement. When they trade the stock, it's just like buying and selling shares of stock is a 2 business day settlement. So you have to buy the stock in 2 business days. Remember, trading the option itself, because options are financial instruments that can be bought and sold too. The option itself is a 1 business day settlement. If they exercise the option, they're trading the underlying stock. That's a 2 business day settlement. And yes, they have to buy it at the strike price. Yes. What type of option does someone deliver cash? Which one's a cash settlement? And if you're not sure, I can tell you, right, an index option is a cash settlement. That's when they're basically making a bet about the direction of the whole market, right, measured by a market index like the S&P 500. You can't deliver like one share of 500 different companies, so they just deliver the cash difference between the strike price and the level of the index on the expiration date. Okay, did pretty well with that one. Oh, there it is. Buy stock at the strike price. Okay, next one. A customer sells 10 ABC January 50 calls at $4.75 when the market price of ABC is $51 per share. The maximum loss potential is A, $4,750, B, $45,125, C, $50,000, or D, unlimited. Now, questions like these, it may be useful to use your scratch paper, or, because they give you scratch paper at the test center or a marker board or a dry erase board. So if you find it helpful to write things down and look at the numbers. Okay, Amy, got your answer? Mhm. Okay. Okay, Alexis, I'll answer your question momentarily here. Give everyone a chance to answer. Amy, when we said pass, does that mean you're passing on answering the question? Because you already did. Okay, I think that's everyone. All right, so let's check this out. So customer sells 10 ABC January 50 calls at 475. What's the maximum potential loss? Well, as the seller of a call option or the writer of a call option, okay, they've given someone else the right to buy ABC stock from them at a fixed price, at a pre-agreed price. So let me go ahead and put down a T chart for you here. Let me see if I can. Yes, it's working. It's working. Okay, glad, good. I set that up ahead of time to just copy and paste it. So what was the first thing they did here? So the first thing they did was sell the call option, right? And this is an opening sale, right? Because they established a new position, a new investment. So they're selling to open, sell the calls, and for plus 4.75, $4.75 a share. Okay. Now, what has this done? They've given someone else the right to buy ABC stock from them at $50 a share. Well, what if the person comes back and says, okay, I'm going to exercise my call option and buy ABC stock from you at $50 like we agreed? So it's like, right? So it's like I'm using my coupon, right? So what does he got to do? He got to sell ABC stock to them at $50, just like they agreed. Okay, so at this moment, there's up by $54.75 a share. Well, since he doesn't have ABC stock, and yes, Alexis, to answer your question, it didn't say he was long the stock. If it doesn't say it, don't assume it, right? Work with what it tells you on the page. In which case, he doesn't have ABC stock, so he's got to go get it, and he's got to go buy it at whatever the price is now. So the higher it goes, the more money he's going to lose. Because we keep going higher and higher, he's got to pay higher prices for it just to sell it to somebody at $50. So how high can the price of a stock go? Okay, right. There's no ceiling, there's no limit to it. It can go up in an unlimited amount. So if $54.75 comes in and infinity goes out, what's the maximum loss potential? Okay, correct. It was unlimited. Yes. Okay, so Amy, you answered it right off the top there when you said when you answered choice D. So there was no need to pass on it. You got it. You worked it out. Okay. So yes. So so you're doing okay. All right. Are ready for the next one? Okay. Oh, I thought that was the previous question, but you'll take the win. I'll definitely take the win. The purchase of a call has all the same characteristics of buying stock, except A, unlimited gain potential in a rising market. B, limited loss potential in a falling market. C, low liquidity risk if the position is to be liquidated. D, no erosion of value as the position is held. Okay, I think everyone's answered. So the purchase of a call option has the same characteristics as buying the stock, except, now again, this is an except question. So we have to find the false answer choice, right? We got to find the lie. Do they both have the same unlimited gain potential in a rising market? Yes, because they buy the stock at a certain price and it can go up to an infinite amount. So yes, unlimited potential gain by buying the stock or buying a call. Is there limited loss potential in a falling market? Both of them, yes. You can't lose more than the amount of your investment. Whether you bought the stock or you bought the call option, you can't lose more, so your losses are limited. They could be significant, but they are limited. Low liquidity risk if the position is to be liquidated. Both of them are true, right? Buying stocks that thanks to the stock exchanges and options thanks to the options exchanges, there's a ready-made market for them. That's true that some stocks and some options may be more liquid or less liquid than others. That's a possibility. But what about choice D? Having no erosion of value as the position is held. That's true for stocks. Stocks don't lose value just because time goes by, but options do. The time value of an option decays. It goes ultimately going down to zero on the expiration date. That's the thing about options, right? They only last for limited time, and the time value erodes. It keeps going down and down as time goes by, eventually going down to zero. That's why time works against the option buyer and works for the option seller. So the one that is not identical is choice D. That's definitely an advantage that buying the stock has over buying on options. Options will erode in value as time goes by. Stocks don't. Stocks, well, conceivably last forever. Is there any part of that you need a little help with? Is there anything that didn't make sense? Because I noticed there's some difference of opinion in this one. Did it make sense, for example, why A and B were true answers, were true choices? Okay, thank you, Ashley. And thanks, Alexis. Appreciate it. Okay, thank you, Colby. A customer sells two ABC January 40 puts at $9 when the market price of ABC is $35. The stock falls to $25 and the customer is assigned. The customer then sells the stock in the market. The loss is A, $1,200, B, $1,400, C, $1,800, D, $2,000. Drawing up a T-chart could be very helpful with questions like this. Okay, some answers are coming in. One more. Okay, I think everyone's answered. So let's do the T-chart. Okay, and let's work things out. Okay, first thing to do is, again, this was someone sold or wrote the January 40 puts. So again, this is an opening sale. Right? Their first transaction was a sell order. And of course, we mark down on the money in column that we sell the puts for plus $9 a share in premiums. Okay, the stock falls to 25 and the customer is assigned. What does that mean, right? He's now got to live up to the terms of the contract. So the person who gave him that, who sold that option to, is going to come back and says, I'm going to use my put option and sell ABC stock to you at, right, at what price? At $40, right? Like we agreed. So we were going to, what does he got to do? He's got to buy it from him. He's got to buy ABC stock at $40. Okay, now, okay, because the stock fell to 25. After all, is this option in the money now? Would you want to sell something for $40 that's worth $25? I think you would, right? Okay. Well, he's assigned, so he has to live up to the contract and buy it from him, and the customer sells the stock in the market. Well, what's the market price? Market price is now $25. So we're going to sell ABC for plus 25. So a total of $40 went out, and a total of, what is that, $34 came in, right? Am I doing my math right? 40 went out, and yeah, $34 came in. Okay, so that's a difference of how much? A difference of $6. Oops, hang on a sec. Okay, so our total is minus $6 per share times 100 shares per contract times 2 contracts, and therefore minus 1,200. And so our best answer choice is A. So the question is, would you double it? Yes, because it's for 2 contracts. Okay, now this is just me, by the way. I mean, people can do things. Sometimes people do things differently. I personally like to do it on a per share basis, right? And figure out the gain or loss per share, and then I multiply by the number of shares and the number of contracts. Okay, good. Oh, I'm trying to see if I can get rid of this stuff here. Oh, there it is, 1,200. Okay. The maximum gain for a holder of a put is A, the premium paid, B, unlimited, C, strike price minus premium paid, or D, strike price plus premium paid. Okay, so maximum gain for the holder of a put. Remember, the holder is the buyer. And a put option means they have the right to sell the stock at a fixed price. Now, they'll profit, of course, if the stock goes down, right? Because the lower it goes, they can buy it when it's cheaper and cheaper, and then exercise the put option and sell it to someone else or put it to somebody else at the strike price. Now, their maximum gain is not the premium, right? The maximum loss is the premium. The most they could lose is the premium if the option is out of the money on expiration date, and basically it didn't work out, right? Took a chance, it didn't work out. The maximum gain, though, is not unlimited. It is for the holder of a call option because they can buy the stock at a fixed price and sell it when it goes up. Well, if they have a put option, they can buy the stock when it's cheaper and sell it at a fixed price. But there's a limit to how low a price of a stock can go, can't there? Right? It can't go below zero. So, but remember, before you can show a profit, though, you have to cover your expenses. And the expense you have, right, of course, includes the premium paid for the option. You have to cover that cost. So you can sell it. So the most you can make, right, the most you can possibly make, you buy the stock for basically nothing, sell the stock at the strike price, and keep the difference, except, of course, for the premium that you pay for the option, right, for the privilege of locking in your price. So the maximum gain is strike price minus premium. Would you like me to go through that? Does there anyone have a question? I can walk through with you if you need. Okay, all good? Good deal. Which of the following option strategies provides a gain equal to the premium in a bear market? A, long call, B, short call, C, long put, D, short put. Okay, all right, give me a few more seconds. Okay, so which of the following strategies provides a gain equal to the premium in a bear market? Well, first off, the gain, right? Remember, the maximum possible gain is the premium for the seller of an option or who's short the option. Someone who owns the option, well, they have either, well, if it's a call option, unlimited gain, and it's a put option, well, it's not unlimited, but it's still significant. So it would have to be the short option. Now, which one would you gain in a bear market? Which one is the bear? When the sell option is the bear strategy? Well, buying the call option is the bullish strategy when you think it's going to go up. So the person who sold in that option has the opposite opinion, who thinks it's going to go down. So in a bear market, yes, it would be the short call, the seller of a call option. Okay. If it had been a bull market, then the gain would have been the short put. The seller of a put option would profit if the stock goes up, or at least stays the same, as long as it stays above the strike price. Then the option expires out of the money. The option seller gets to keep the premium without having to do anything else, without having to live up to the contract. Okay. Again, if it's not clear, let me know, okay? A customer sells short 100 shares of ABC stock at $40 and buys one ABC March 40 call at $5. The maximum potential loss is A, $500, B, $3,500, C, $4,500, or D, unlimited. Okay, thanks, Hannah. All right, let's check this out. So let's do a chart here. Okay. So customer sells short. Okay, again, their first transaction, this was to sell something. This is also an opening sale. Okay, so we're going to sell ABC for $40, right, in a short sale, right? The idea is, right, buy it back later, hopefully at a cheaper price. Also buys the ABC March 40 call. So they're buying a call option too. Now, why did someone buy a call option when they sold the stock short? What does buying the call option do for them? When someone has a position in the underlying stock and they purchase an option to go with it, yeah, in this case, they're using it as a hedging strategy, right? Okay, in case it doesn't go according to plan. By selling the stock short, of course, this person is bearish, expects the stock to go down. But just in case it doesn't work out that way, also buy a call option, because then they have the right to buy ABC stock back again at the strike price, no matter what the actual price is. Okay. Question says, so short means that they owe, but selling the stock means they gain. Well, first off, they had sold something. Remember, in a short sale, it does mean owe, right? Because they borrowed 100 shares of ABC stock from their brokerage firm. So they owe their broker-dealer, like they're coming up short 100 shares of ABC. The plan is wait for ABC to fall in price and then buy ABC back again when it's cheaper and keep the difference. But why buy the call option? Because, see, if the stock goes down, the customer would make money because he gets to buy it back at a cheaper price. But if it goes up instead of down, then he'd have to replace what he borrowed at a higher price. Buying the call option ensures that he could buy the stock at $40 a share, at least until the March expiration date. So let's assume that happens. Let's assume the stock goes up and he does, in fact, exercise the call option, which he has the right to buy ABC stock at what price? At the strike price of $40. Okay, so that would be his. Now, you see, by buying the call option, he's just bought disaster insurance, and he knows his worst case scenario. $40 came in, and a total of $45 went out. That's minus $5 a share times 100 shares, and so the maximum potential loss is $500. Okay. All right. So again, Karina, I hope this helps answer your question. But if he bought by buying the stock back again, what if the stock did in fact fall in price? What if it went down to $30? Okay, in that case, $40 came in and a total of $35 went out. So he would actually gain $5. That'd be a $5 profit. That's the idea of the short sale. Is that clear? See how we do it? Good deal. Thanks, Karina. My pleasure. You're welcome. Okay. On the same day in a margin account, a customer sells short 100 shares of ABC at $44 and buys one ABC January 45 call at $2.50. The customer will break even at A, $41.50 per share, B, $42.50 per share, C, $46.50 per share, D, $47.50 per share. Okay, counted 7, so let's see what our answer is. Okay, again, very helpful to have a T-chart here. All right, so on the same day, in a margin account, a customer sells short ABC at $44. Again, that's an opening sale. So we're going to sell ABC for plus 44, $40 comes in. Buys the January 45 call at $2.50. So now we're buying something. We'll make a note of that on the money out column. Buy the call for minus 250. All right, so at this point, where does our investor stand, right? What's his cash position now? If 44 came in and $2.50 went out. Well, in that case, so at this moment, he's up by $41.50. So now that he sold the stock short, eventually he's going to buy the stock back again later. So since he's up by $41.50 right now, if you were to buy ABC stock at exactly $41.50, then a total of 44 went out and a total of 44 came in. And therefore his break even, right, 41.50. Okay. Now, I noticed many people chose choice D. So let's go back again. Can you tell me how you worked it out to 47.50? Because you might have done the steps a little differently. Can you walk me through your steps? Okay, 41 plus 250. Ah, okay. Having bought ABC, bought the call option, nah, that's money going out, right? Okay, as opposed to selling the call option, right? Okay, someone says 45 plus 250. Okay. Notice you said the question is, where does the customer break even? Where does the break even point is where the price of ABC stock has to go, where this investor shows zero gain, zero loss, absolutely just breaks even. Okay. And notice it didn't say anything, right? It doesn't actually exercise the option in this case. We're just going, okay, now let's just set it up. Where do you break even? Where does it have to go? So ABC, he's expecting ABC stock to go down, right? That's why he sells it short. By buying the call option, again, as disaster insurance, yeah, it's got to go down by another $2.50 before he can show a profit, right? Just that's because that's cover his costs, it covers his expenses. So he's got to cover that cost before he can show a profit. That's the whole thing about using options as a hedging strategy. The idea is, yes, it is insurance, right? Insurance costs money. And before you can show a profit, they have to cover that cost. It's got to go down by enough before, right, to cover that cost. He's got, right, but once it does, the idea, of course, is that worst case scenario, he can always buy that stock back at $45, no matter what. Even if it goes to 50, 60, 80, 100, he can buy it back at $45 and he limits his losses, knows the worst case scenario. That's the idea, right? You give up some of the upside because it protects against the downside. Oops, didn't want to do that. Okay, let's bring another one here. A customer sells short 100 shares of ABC at $54 and buys one ABC January 55 call at $6. ABC goes to $79 and the customer exercises the call to cover her short stock position. The customer has A $600 loss, B $700 loss, C $2,000 loss, or D $2,100 loss. Hmm, I think we're waiting for one more. Okay, all right. So again, a very good use for the T chart. So again, we'll follow the steps here. Customer sells short, another short sale, another opening sale. So we'll mark that on the money in column, sell ABC for plus 54, and then buys the 55 call. Oops, I didn't want to do that. Hang on. Buys the 55 call. Again, why? Again, you can always tell it's a hedging position when someone has a position in the stock and then they buy an option to go with it. Okay, so we're going to buy the call for -6. Okay, so at this moment, right, our customer is in pocket by what, $48 a share, right? So that's the break-even point too. Okay, he's got to go down below $48 to show a profit. Okay, but in this case, the stock went up, not down. and went to $79. So that would be like a $25 loss, right? $25 going the wrong way. Does our customer have a $2,500 loss? No. Why? Because our customer, she bought a call option. She bought the January 55 call. So she exercises her call option, which gives her the right to, right? The right to buy ABC at what price? At the strike price of $55. So what happened is 54 went out and a total of 61 came in. That's a $7 difference. So our answer is B, a $700 loss. Okay. All right. Again, some difference of opinion on this one. Do you see how I worked it out? Is there any part of it that's not real clear just yet? Okay, let me put this on. I'll put this back on here so that you can see how I worked it out. So sold it short at $54. So I marked it down here after 54. Buys the call, buys a 50 call for $6. That's $6 premium. Okay. Then exercises the call option. We have the right to call option, right to buy 100 shares of ABC stock at $55 until January's expiration date. So we're going to exercise it. So 54 went in and a total of 61 went out. That's a difference of $7 per share, $700 total times 100 shares, right? Okay. All right. Well, tell you what, we got. I'm at 4 minutes right past the hour right now. Thought I'd take a very well-deserved break and return at 14 past the hour, whatever the hour is in your time zone. I'm sorry, I keep saying that. It says during the day, I work for different companies, right? And I'm doing Zoom calls, right, with people all over the country. So I keep saying, right, whatever the hours in your time zone. It's got to be such a habit. I forget that you're all local. Anyway, come back here in 10 minutes and we'll continue our questions. Okay, are y'all good? Do you need anything from anything at all? Okay, thanks, Ashley. All right, if you do, okay, unmute and let me know. Okay, see you soon. And welcome back from break. Now I think I'm still connected. I mean, I can see my little thumbnail on the Google Meet page, but okay, thank you, Ashley and Colby. Okay, so Karina's got a question. It's a good one. Okay, why do issuers typically call in shares when interest rates are low? Well, aren't they already saving money during this time? Okay, issuers are going to call in their preferred stocks or bonds when interest rates were high and go down. That's when they're going to call them. Okay, just like when refinancing a mortgage. Interest rates went down to next to nothing. So yeah, I definitely refinanced my mortgage. Okay, so they cash out these old bonds with a higher interest rate, issue new bonds with a lower interest rate, and save a whole mess of money on interest payments. That is when they would call in. So if interest rates were lower and then go up, no, they don't want to call in their bonds now, right? Just like you said, they'd want to keep they'd want to keep what they have, right? They want to keep that and not refinance, right? I don't want to refinance my mortgage now, for example. Okay, I don't want to touch it. Okay. Karina, does that help answer your question? Okay. Right. Okay. Yes, that's it. They're selecting a cheaper rate. Okay. Okay. Good. And Alexis, yes, that's an excellent explanation. Very, very well done. Are you ready for our next question? I've got a few more for you. I think I've got to forget. Okay. However many, I think I have 4 or 5 more for you here on this for this topic. Next one. A customer buys 100 shares of XYZ at $49 and buys one XYZ January 50 put at $5. Just prior to expiration, the stock is trading at $49. The customer closes the option position at a premium of $2. 1 week later, the stock moves to $55 and the customer sells the stock position in the market. The net gain or loss on the transaction is A, $300 loss, B, $300 gain, C, $600 loss, D, $600 gain. Definitely a good chance to use a T-chart. Write them down as you go, so it helps you stay focused, right? And you can see how you're doing, and you don't end up getting all lost in the details. Okay, it looks like everyone's answered this one. And so let's work it out. The customer buys 100 shares of XYZ at 49. So this is an opening purchase, okay, or a buy to open. So we're going to buy XYZ at 49, then buys the XYZ January 50 put. Okay, so it's another buy order. So we're going to buy the put for -5. Okay, so again, these are both opening purchases. Just prior to expiration, the stock is trading at 49. The customer closes the option position at a premium of $2. So how do you close a position? Okay, if they bought to open, you have to do what? How do you close it out? If you buy to open, you sell to close. So we're going to sell the put for $2 plus 2. Okay, then 1 week later, the stock moves to $55 and the customer sells the position in the market. So another opening position, an opening buy is finished off with a closing sell. Sell XYZ for plus 55. All right, so with a look at all together here, so a total of 54 went out and a total of 57 came in. So that sure sounds like to me like a $300 gain. Everyone got this one. All right, and this was a more involved here. There was a lot going on in this question, and everybody nailed it. Oh yeah, Alexis. Okay, right. Okay, so I have a feeling you're getting the hang of it. All right. Round of applause, Kimberly. Absolutely. All right, now we're going to see. You must feel pretty good about this one. Okay, so I think you're getting the hang of it here. There was a lot to that one, so you did good. A customer sells short 100 ABC stock at $60 and sells one ABC October 60 put at $6. The break-even point is A, $54, B, $60, C, $66, D, $70. Yes, I do believe that's everyone. All right, let's check this out. And it looks like everybody chose the same, which either means you all worked it out the same or you're all cheating off each other. So let's check it out. So customer sells short. All right, another opening sale. We're going to sell ABC for 60 and then sells the put option. Now, what type of strategy is this here? When someone has a position in stock and then they sell an option. We know if they buy it as a hedging strategy. So what are they doing by selling options? So yeah, selling the put. Mm-hmm. Right, what's that strategy? This is an income strategy. Okay, when you have a position, then sell. That's a covered writing because you have a position stock and then sell an option along with it, and they're selling it for the income, right? For the premium that they collect. Basically, they're getting paid to pre-agree to trade at a fixed price, which they're eventually going to do anyway, right? If someone sold the stock short, they're going to buy it back eventually. So by selling a put option, they're getting paid to agree to buy the stock at $60 a share. Got paid $6 to do it. So since they sold the stock for 60 and then sold the put for another $6, this customer's up by $66 a share. We know he's going to buy it back eventually. So what if we were to buy it for exactly $66? Then 66 came in, 66 went out, and their break-even point right? They're ground up, right? There would be a bottom line of 0 for a break-even point of 66. Okay. Had they bought the option, because see, all the ones we saw up to this point, those were hedging strategies where they had to buy the option, and it's got to move that much. Okay. But this case, yeah, this case they sold the option. Now remember, by selling the put option, remember they make money if it goes down, they lose money if it goes up. But by selling this option for $6, they just gave themselves a 6-point cushion. So the stock that they sold for $60, it can still go up, right? Which is the way they don't want it to go, right? That's the opposite. But it can still go up by $6 and they still haven't lost money. If it goes to $67, then at that point they start to lose. Because then they have to pay more for it than the total they collected. Are you any part of it that does not make sense? Is there any part that's, if I gave you another one that looked just like this, would you be able to do this question? Okay. I'm just checking to see if there's anything else. Maybe. Okay. Okay. So again, if you just notice, I just lined up the T charts, right? When I see what the position looks like, I say, well, now that this much money came in, how much money would have to go out to be 0, right? Okay. Okay. Thanks, Colby. All right. Let's try another one then. To generate additional income in a stable market, a customer who is long stock could A, buy a call, B, sell a call, C, buy a put, D, sell a put. All right, I think that looks like everyone has answered this one. And so our answer is here: to generate additional income in a stable market. The customer is long stock. What does long mean? Long means own, right? They already own the stock. Sooner or later, they're going to sell the stock, right? What if they just got paid to pre-agree to sell the stock to someone else at a fixed price? So they can do that by selling a call option, right? This would be called covered call writing. Okay, good. And by doing so, by selling the call option, they collect this income, right? They collect that cash premium. And whenever someone collects cash, to at least some extent, this offsets their risk. So writing the option like this, right, gives them a partial hedge, a little bit of downside protection. If they want full protection, they would have to buy a put option, right? You have to buy insurance if you want full protection. But by selling call option, they collect some premium, offset some of their risk, okay, and maybe enhance their rate of return a little bit too by collecting a few extra dollars. Okay. Now, why would this be in a stable market? You see, you wouldn't want to do this in a growing or a up market, right? Okay. Okay. Right. You wouldn't want to do that because right, because then you'd have to sell the stock to somebody at the fixed price, right? You limit your upside, you limit your gains because they pre-agree to sell their stock to someone at a fixed price. They wouldn't want to do this in a declining market either, because then the stock's just going down, and maybe they don't want to hold it at all. But in a flat market, a stable market, it makes sense to sell the call because then the stock's not appreciating at this point, right? So you at least can collect a little something out of it while it's taking that breather, while it's going sideways for a while. Let's try our next question. A customer sells short 100 shares of PDQ stock at $59 and sells one PDQ October 60 put at $6. The market rises to $68 and the put expires. The customer buys the position in the market covering her short stock position. The gain or loss is A, $100, B, $300 loss, C, $600 gain, or D, $900 loss. Okay, let's see. 1, 2, 3, 4, 5, 6 so far. Okay, good. Let's work this one up. All right, customer sells short 100 shares of PDQ stock at $59. So that we'll put that on the money in column. Sell PDQ for plus 59. Sells the October 60 put. Okay, so that's another opening sale. And again, we recognize this when they have a position and sell an option or write an option. Yep, this is an income strategy. This is actually called covered put writing. when they have this short position in the stock and sell a put option to go with it. So they collect some extra premium. Okay, because now, right, the break-even point now is right would be 59 plus 6 would be 65. So the stock that they sold short at 59, the hope goes down, but it could go up as high as $65. They still haven't lost money. Okay, but the market rises to $68 and the put expires. So this goes away. Okay, it goes away. And okay, and the customer buys the stock in the position, buys the stock at market, covering her short position. So now we're going to buy PDQ stock at the price of $68. So let's see. So it looks like a total of 65 came in and a total of 68 went out. And that makes it a $300 loss. Okay. Is there any, again, if there's any part of that doesn't feel like clear, like you could follow along with that, like if you saw this kind of question again, do you feel like you could do it? If you feel like maybe you're not so sure, this would be a good time to ask. Okay, thanks, Karina. Okay, again, we just notice I'm just going through it step by step, right? Line by line. A customer buys 100 shares of ABC stock at $39 and sells one ABC January 45 call at $2 on the same day in a cash account. The customer's maximum potential gain until the option expires is A, $200, B, $300, C, $700, D, $800. All right, so I think everyone's answered. Let's go ahead and crunch the numbers here and see how we worked it all out. Okay, by the way, I've taken to hitting the pause button while you're answering the questions. So when you see the playback later, I've cut out a lot of that stuff in between. So okay, so hopefully it makes the recording a little more interesting. Customer buys ABC stock at $39. Buy ABC for $39, and then sells or writes. You can say that, remember, or is short one ABC January call. So we're going to sell or write the call option, sell call plus 2. Okay, so at this moment, right, 39 went out, 2 came in, so our customer's down 37 right now. Okay, so what's the break even point, right? $37. If he sold it at $37, he'd exactly break even. Okay, what's the customer? But the question is, what's the maximum potential gain? Now, of course, having bought the stock for $39, he's going to profit if it goes up. All right, and the higher it goes, he's going to make more and more profit, right? Is there any limit or ceiling how high of a price of a stock can go? There's no limit to how the price of the stock can go, but there's a limit to how much he can profit. How come? By selling or writing the ABC January 45 call has given someone else the right to buy ABC stock from him at $45. So he's pre-agreed he'd let it go at $45. So let's go ahead and assume that happens. We're now going to sell ABC at the strike price of $45. So if 39 goes out and 47 comes in, what's our maximum possible gain? $800. $8 a share times 100 shares. All right, good. Okay, now if you might have chosen choice A, thinking that as the seller of a call option, the most you can make is the premium, right? That would be true. Remember, that would be true if someone just sold the option by itself, right? Writing uncovered call options. But now we have to account everything, and we have to keep everything in mind now. The fact that he bought the stock itself and sold the call option, this is a different strategy. Just selling the call by itself is a speculative strategy. Speculation is a nice way of saying gambling. Okay, making a bet about which way the stock's going to go. So being right, he would have been bearish had he just sold the stock itself. But in this case, he owns the stock and then sold the call option. So we have to take things in conjunction, right? Using the stock and the option together as a part of the strategy. This strategy, again, is an income strategy of covered call writing, collecting some cash premium. His bet basically is that ABC stock is still going to stay below $45 by the time January comes around. Because if it is, that the option will expire out of the money. No one's going to buy something for $45 if it's worth $42 or $43, and they figure the option will just expire, goes away. Well, doesn't have to, right? He still owns his stock because no one bought it from him, no one exercised the call. Still holding on to the cash, still holding on to $200 for selling the call option, and no longer has an obligation. The option expired, it's gone. So why not do it again? Sell the February 45 call, sell the March 45 call, sell the April 45 call, and just keep on collecting premiums like that, one right after the other. Okay, again, if you need some help with it, if it's not clear, please let me know, okay? Next question is, an opening trade in a call option contract takes place on the American Stock Exchange between a buyer at ABCD Securities and a writer at PDQR Securities. The issuer of the contract is A, the American Stock Exchange, B, ABCD Securities, D, PDQR Securities, or D, Options Clearing Corporation. Yeah, sure thing, Karina, no problem. Okay, so we got an opening trade and a call option on the American Stock Exchange, okay, the Amex, between a buyer at ABCD, a writer at PDQ Securities, and who's the issuer of the contract. Basically, where do option contracts come from, right? Who is the issuer, the guarantor, and obligor of options contract is all the Options Clearing Corporation, the OCC. That's where they come from, okay? That's as the clearing corporation, right? They're basically behind the scenes of it all, matching up buyer and seller. Right? Ensure that when someone buys something option, right, the buyer gets the option, the seller gets the cash. When someone sells an option, the writer of the option, right, make sure that the writer gets the cash. Okay, and of course, when someone exercises the options clearing corporation is back behind the scenes. If someone exercises their option, that are matched up to someone else who sold that option, so a buyer is matched up with a writer and executes a trade in between them. So the OCC, that's where options are generated. That's where they all come from. Okay. All right. Are you good? Okay. Please, I know I'm sounding like a broken record here, but if you need any extra help with that, please feel free. You can raise your virtual hand or ask a question, just unmute and ask, or type a message in the chat, and I'll do my best to answer. Okay. All right. That was the last question that I had from our series here. So if you hold on, let me go. And there was a request here about types of preferred stocks. So hang on a second. Okay, let me bring this up again, and got a slide deck for you here. Okay, so these are the variations of a preferred stock. Now the basic preferred stock that's got no other feature to that, they either call that a either a straight preferred, okay, or another name for it is a non-cumulative preferred. Okay, so that just means they're just sold at a par value of $100 per share, right? So ground floor investors buy them at $100, and they collect a percentage of that par value as a dividend. So percent, like it was a 5% preferred stock, 5% of $100 is $5 a year, and they just collect $5 a year in dividend payments. Some preferred stocks pay their dividends on a quarterly basis, the way common stocks do, and some of them pay semi-annually, the way bonds do. So for the test, you'll probably work under the assumption that they pay semi-annually. I don't know that it'll really mention it, but just in case it does. Okay, but normally if they're going to ask you the question, they've got to provide you the information. Okay, now some variations have come around about that. One of those is a cumulative preferred. Now remember that they look and act like bonds, but they're not bonds, right? They are stocks. They're equity investments, and that means ownership. One difference is that preferred stocks pay dividends while bonds pay interest. Bonds are debt instruments, and there's a legal obligation to repay debts with interest. There is no legal obligation to pay dividends. Yeah, so it's entirely still up to the discretion of the company's board of directors. And the board could decide that they're having cash flow problems, and they could elect to reduce or even skip over dividend payments. Now, if it was a non-cumulative preferred stock and the company reduced or skipped dividend payments, investors are just plain old out of luck. However, if it has a cumulative feature, this one says that the company must make up any back dividends that they skipped over or missed, plus they have to pay the dividend for this year before they can start paying dividends on common stocks again. So this gives a little protection, a little assurance to investors of preferred stocks that if they do miss dividend payments, they're supposed to make up for it eventually. Okay. You might have seen questions like that. Well, what the question might look like. So let's say it's a 5% preferred stock, and it's supposed to pay $5 a year. But 2 years ago, they only paid $3, and last year they only paid $1, and now they want to start paying dividends to common stockholders again. Okay. So how much do they have to pay? Well, first off, 2 years ago, they were supposed to pay $5, but they only paid $3. That's $2 in back dividends. Last year, they were supposed to pay $5, but only paid $1. That's $4 in back dividends. That's $6 so far, plus the dividend for this year, right, which is another $5. So that's $11 total in back plus current dividends before they can start paying dividends to common stockholders again. Okay, so that's a cumulative preferred. Our questions are all these insurance for the shareholder? Well, the cumulative feature is yes. The callable feature, however, this is not good for the shareholder, right? Not from the investor's point of view. A callable preferred, that means that the corporation, the issuer, has the ability to call the preferred stocks away from investors and cash them out and give them their par value back, give them their $100 back. Right. From the investor's point of view, probably not a good thing because they'll get their money back, but they're going to stop receiving these dividend payments that they've been collecting. Now they get their money back, they got to reinvest it someplace else. But if interest rates have gone down since that preferred stock was created, and it probably has, well, they won't be able to reinvest it at the same rate of return they did before. They won't get the same dividend payments. They face a loss of income. So from the investor's point of view, having a callable preferred stock, there's an extra risk to it. In fact, it's even called call risk, to be more precise. So therefore, since there's additional risk to the investor, well, investors, remember, are not going to take more risk unless it's a risk we're taking. So a callable preferred will have to offer a higher dividend than a non-callable, all else being equal. All right, a convertible preferred, again, I wouldn't call that insurance for the shareholder. The cumulative feature, yes, but not the convertible feature. But a convertible, that means that the investor, the holder of a preferred stock, has the ability to swap their shares of preferred stock into so many shares of the company's common stock. The number of shares they can exchange it for is established. It's set when the preferred stock is created. So they always know how much that is. So if they do that, what does it do? It allows someone to basically, who has a preferred stock, to participate in the growth of the common stock, but without the risk of the common stock. See, if the common stock ends up doing well, right, if the common stock grows, then it would make sense. Swap the preferred stock to so many shares of common stock, sell the common stock for a profit. But if the common stock doesn't go anywhere, you know what? You still got your preferred stock, and you're still collecting your dividends. So question here is, do shareholders choose which type of preferred stock to buy or participate? Yes, they do. Now, of course, companies will decide also what type of preferred stock they'd like to offer. Okay, so investors, right, and investors and issuers can decide among themselves which one they'd like to have or would prefer to have. All right, so the conversion feature. All right, so first off, they might have a conversion ratio. And the conversion ratio is equal to the par value of the preferred stock divided by the conversion price. The conversion price is equal to the par value divided by the conversion ratio. All right, now this is not at all complicated. In fact, you already know how to do this because you know how to make change. Because if I said, if you have a $1 bill and I said you can convert it into quarters at 25 cents a quarter. How many quarters do you have? Right? You have 4 quarters, wouldn't you? What if I said you have a $1 bill and you convert it into 4 quarters? How much is each quarter worth? You already know that, 25 cents. So what if you have a $100 par value preferred stock and you can exchange it into 4 shares of common stock? Well, in that case, you take your $100 preferred stock, turn it into 4 shares of common stock. It's like buying 4 shares at $25 a share. It's like buying the common stock at a fixed price. So if it goes above 25, it would make sense. Or again, what if I said you have a preferred stock and it's convertible to common stock at $25 a share? Well, again, if you make change, you take your $100 preferred stock, turn it into common stock at $25 each, you end up with 4 shares of common stock. Okay. Question here says, why would someone choose a callable preferred? Okay, basically, if they do, they're making a bet that interest rates are not going to go down. They'll stay the same or go up from where they are, and they're not going to call the preferred stocks away from them, and they still get to enjoy a higher dividend payment. That's their point of view. That's their call. We'll see what happens, right? Okay. All right, a participating preferred. This is where the investors receive their stated dividend, right? They'll get their dividend payment, and they just may, be able to participate in additional dividends over and above the stated dividend. It's not assured, but it's a possibility. So you might see it described as a 5% preferred stock participating to 7%. So this means, first off, the company's going to pay them their $5 a year, their 5%. Then they'll pay dividends to common stockholders, and then, if the company had a good year, if the board of directors is feeling generous, they could get an additional $2. They can't promise it to be sure, but it is a possibility. So with a participating preferred, the stated dividend payment is the minimum, not the maximum. My pleasure, Karina. Okay. Okay. And that is our review about preferred types of preferred stocks. Okay. Now, again, with a preferred stock, again, they're a fixed income investment, like bonds are fixed income investments. So preferred stocks look and act a lot more like bonds than they do common stocks. Only common stock has growth potential. Okay, if you want to invest in the company's growth potential, you buy common stock. As the company grows, hopefully the value of the common stock grows too. Preferred stocks, you can only really expect to collect your dividend payment. It may go up or down a bit from that, but not much. So you want real growth potential, it's common stock. But then again, you've got the risk of common stock too. If the company ain't doing that great, then its common stocks are going to go down. So preferred stocks offer stability. They probably have a higher yield, though, than a bond. Bonds are safer than preferred stocks, right? Because, again, bonds are a debt instrument, and there's a legal obligation to repay their debts. True, there's a chance of default, but there's still that legal obligation. Preferred stocks do not have a legal obligation to pay dividends. All right, hope you found that helpful. Awesome. Okay. Okay, thanks everyone for your virtual thumbs up. All right, hang on a second while I go clear this out. Okay. Stop here. Okay. Oh, avatars are great. Okay, that is 7. So I think we're ready to go. Let's play Family Feud. The income level of a donor, A, will affect contributions into a Section 529 plan. B, may affect contributions to Coverdell ESA and Section 529 plan. C, may affect contributions to a Coverdell ESA. D, will not affect contributions to a Coverdell ESA or a Section 529 plan. right, so a little over the place here. So I know the question was a little kind of random sounding to start with. The income level of a donor. You didn't really make any sense until we started looking at the answer choices for it to make context. It's basically here the difference between a 529 plan versus a Coverdell. Coverdells have income limits. So if someone's income is above a certain dollar level, I don't worry about memorizing what the dollar level is, but it's six figures, right? It's more than $100,000. They cannot use a Coverdell. But 529 plans do not have income limits. Oh, you didn't even get a chance to answer or even time to think. Okay. Yeah, as I kind of looked at this, I was realizing it kind of like was a little too quick all right off the bat there. But okay, I'll try and keep that in mind when next time I set one of these up. Okay. Okay. But anyway, the idea is that Coverdells have income limits. 529 plans do not. All right. So let's see how we did here. All right. Alexis got some points up. Let's check our next question. How an account is registered determines A, the sole individual allowed to access the account. B, ownership and control of the investments in the account. C, ownership of the account. Control of the investments in the account. There we go. Yes. The account is registered, or the titling of the account determines both the ownership and who can control the investments. Now, of course, if someone's account's in someone's own name, right, an individual account, it's their account, it's their property, they own it, and of course they control the investments too. They control it. But what about something like a custody account? Right? A custody account is an account for a minor. Okay, now the minor owns the account. It is the minor's property, and it's an irrevocable gift once given. Right? But the minor, right, doesn't control the account. The custodian controls the account, but as a fiduciary, right, has that responsibility to the minor. Right? Okay, that's great job. Let's see who scored here. All right, everyone's got some points up now. Let's check our next question. Under whose social security number is a custodial account established? A, the person who established the account for the minor. B, the minors. C, the parent, whether the minor is the custodian or not, parent is the custodian or not, or D, the custodians. It is the right in a custody account under Uniform Gift to Minors Act, UGMA, or the Uniform Transfer to Minors Act, UTMA. It is the minor's property and is irrevocable gift, and as the minor's property, the account's under the minor's social, which also means any taxes on the investment income are the minor's taxes. Yes. Oh, you can't think this fast at this hour of the day. Oh dear. Okay. Well, hey, we'll do our best, and of course, hopefully on the real test, it won't be this late at night. Okay, so you'll have the chance to be be a little more alert and think on your feet a little bit. Anyway, hang in just the best you can, and it's all practice, so we're no worries about that. Okay, yes, it's the minor's property, it's the minor's social security. Thanks, Amy. Alexis got three in a row and moving up on the board. Let's check this out. John and Tara Bourne have two children, Henry and Avery, and they want to set up custodial accounts. Which is allowed? A. John and Tara Bourne, custodians for John and Tara Bourne, custodians for Henry and Avery Bourne. C. John Bourne, custodian for Henry Bourne. D. John Bourne, custodian for Avery Bourne. All right. So it was a mix here between the C and D. But if we remember, the way that custodian account has to be titled, right? There can only be one named custodian for only one minor. And that's the way the account must always be set up. So John Bourne, custodian for Henry Bourne, would work just fine. John is custodian for both Henry and Avery. Not good, right? Because they must always be individual accounts. There are no joint custodial accounts. Okay. And John and Tara, custodians for Avery, can't do that either. Can't have more than one custodian. Only one custodian for one minor. All right, Amy moves up, and Alexis, four in a row. Okay. The primary use for a revocable living trust is to A. Use as a substitute for a will. B. Limit the grantor access to items in the estate. C. Avoid tax consequences for the grantor. D. Prevent the grantor from liquidating their estate prior to death. This was a difficult one, but the purpose of a revocable living trust, yes, is in place of a will. Because as a revocable living trust, right, that means that the grantor who set up the trust, remember, a trust is set up by a trust grantor or trustor for the benefit of one or more beneficiaries, the person who gets the assets of the trust. So the trustor puts money into the trust or assets into the trust for the benefit of one or more beneficiaries, and a trustee is appointed to handle the assets of the trust according to the instructions given by the trust grantor and as a fiduciary to the beneficiaries. Yes, Hannah?
I thought that with a living trust, though, it's also to protect the assets in the trust, so to protect the trustee or whoever's in charge of it from draining the assets. I thought there was stuff put into place to keep that from happening.
Well, you could say that. The assets of the trust, right, is going to be used specifically according to the instructions given by the trust grantor. So, yes, I think you can say that we can use that to prevent it from being misused. Good. Okay. But yeah, it does substitute for a will because the assets of the trust will be given to the beneficiaries according to the instructions, and that could include upon the demise of the trust grantor. Okay. Being revocable, by the way, that means the trust grantor can change their mind. If they want to name new beneficiaries, they can do that. If the beneficiary custodian account dies, the securities in the account pass to A, the minor's estate, B, the parents, C, the custodian's estate, D, the Securities Investor Protection Corporation trustee's account. Should the minor pass away, remember the assets of a custodian account are the minor's property, an irrevocable gift. Should tragically the minor pass away, the assets transfer to the minor's estate. From there, it goes through probate and basically given to the minor's heirs. Okay. Now they usually don't have a will at that age, so in that case, they may be passed along according to state intestate laws. Okay, but when someone dies without a will, that said they died intestate. And so therefore the assets have to be distributed according to state laws. No, not the custodian's estate, because that would happen. Well, because remember, the state holds the assets of someone who's passed away, so not the custodian's estate. Do minors have an estate? Yes, they do. Right? If the minor has passed away, whatever assets the minor's property transfers to the minor's estate. Okay. No, it does not go to the parents, at least not automatically. And the fourth one, the SIP, I'm glad nobody chose the SIPC because that's just plain rubbish. At a young age, yes. Yes. Says if the amount is under a certain amount, it won't go through probate. That's probably true. But yeah, you don't have to go this deep into it for this test for sure. Okay. Alexis is 6 in a row and a commanding lead. Under the Uniform Transfer to Minors Act, UTMA, a custodian may invest in all the following except A, mutual fund and growth shares, non-investment grade junk, C, U.S. Treasury notes with less than 1 maturity, D, blue chip stock on market. We are not allowed to buy on margin. Correct. Because margin puts a debt on the account, right? That's borrowing money against the value of the account. That puts a debt on the account, and a minor cannot be put in debt. I know you might have been tempted to think, right? You can't invest in junk bonds, right? They're just too risky, but no, they are still an acceptable investment. Yeah, they don't have to be investment grade. Yeah, there's most things they can do, okay, that they can invest in. The other thing they cannot do, okay, they cannot buy on margin, and they can only use Options if they're used for protection. So you can sell covered calls because that's an income strategy which reduces risk, or you can buy put options on investment that they have because that's basically like disaster insurance. So that's, you can't use speculative options, and you certainly cannot use naked options. Alexis, streak of 7. Karina's moved up. Let's check our next one. Which of the following is a benefit of 529 plans but not Coverdell education savings accounts? A, no income restrictions. B, withdrawals are tax-free if used for qualified education expenses. C, can be transferred to a sibling if not used by the original beneficiary. D, available for use for K-12. Yeah, I think we kind of mentioned it earlier, right? With the 529 plans, there was no income limitation. Whereas Coverdell's, if your income's above a certain dollar amount, you cannot contribute or use a Coverdell. So that is definitely an advantage of a 529 plan. Now, originally, 529 plans could not be used for K-12, but that changed about a few years ago. I want to say about 4 years ago. Now they can withdraw up to $10,000 a year for K-12. Coverdell, its original benefit was it could be used for any level of education. Did not have to be college only, could be used for any level, but now 529 plans can be K-12 also. So that's took away a significant benefit that Coverdell's had. But C is a true statement. Okay. Keep in mind with 529 plans and Coverdell's, it's the donor who owns the account. See, with custodial accounts, right, it's the miners of property. The miner just can't gain, they own the property, they just can't access to it until they're of legal age. In a education account like a Coverdell or 529, the donor owns the account. The miner's just the beneficiary. So the kid says, I'm not going to go to college. Well, then you can name a new beneficiary. You can give the money to a family member or someone who's hopefully more appreciative. In fact, I'm pretty sure you can name yourself beneficiary if you want to go back to school. Okay, let's see. Alexis scoring some more points and a mighty commanding lead. Under UTMA, the custodian has control over the account and can do each of the following except A, exercise rights or warrants. B, liquidate, trade, or hold securities. C, shell short or covered options, or D, buy or sell securities. I think I might have mentioned this one. I am so glad you chose that because, yes, I did mention they cannot, well, they cannot trade on margin, right? And short selling requires a margin account, right? In that case, they're borrowing securities, not borrowing cash, and cannot write uncovered options, correct? Can they exercise rights or warrants? Absolutely can. In fact, they might even be liable, right, as a fiduciary if they don't exercise rights or warrants when they're profitable to do so. Alexis, streak of 9? Oh my goodness. Okay, 3 brothers want to open a joint account, and if one dies in the cash and securities to go to the remaining parties, A, they should open an account with rights to survivorship. B, the account should be opened as a transfer on death, TOD account. C, they should open the account as a tenants in common, yes, or the account should be opened as a custodial account. Very good. Yes, okay. Rights of survivorship. Exactly. The 3 brothers want to open a joint account. And by the way, joint accounts can have any number of people on them. They don't have to be 2 people only. And if they want to make sure if one person dies, it goes to the survivors automatically. Rights of survivorship account. Exactly. In fact, that rights of survivorship is so strong, it supersedes a will. That's how strong that is. They wouldn't open as a transfer in death or TOD because then it'll be one brother who owns it. And then it just goes, the names the other brother or brothers as a beneficiary. They want to own it together. Not a tenants in common account because then if one of them dies, then that person's portion transfers to his or her estate, goes through probate, and ultimately to that person's heirs. Okay, but but doesn't have to do so here with the rights of survivorship. A custodial account, no, a custodial account's for a minor. Okay, and they must be of legal age if they want to open joint accounts. Okay. Streak is over. Okay, hey, that was a good run though. Is that the same as TOD? Sorry, as a joint account with rights of survivorship? No. In a TOD account, it would be just one person's property, right? Or these, well, they could make them as joint accounts, but then they would name a beneficiary who won't be on the account. The beneficiary will not be an account owner. Have rights of survivorship.
But then once it's transferred upon death, then they would become an account owner.
It would be yes. I mean, it would send to it would become their property. That's true. But remember, they don't have to own it together. They want to open a joint account. They want to all own the account together. If it's a TOD, I mean, conceivably could, but then they name someone else entirely as the beneficiary. If the one brother wants to open
it. Yeah, it's like semantics, like
part of it, and knowing what, and of course knowing what the rules are. Yeah. Okay. All right. Okay. Well, Alexa's streak was over, but their first place position is still intact. All the following are true of irrevocable living trust except A. The grantor is subject to the tax consequences of the trust law. Its primary purpose is to avoid estate taxes for the C. The grantor can remove items from the trust. C. The grantor can add to the trust. Primary purpose, right, to avoid estate taxes. That is the purpose of it. Yes, as a revocable living trust. So the assets will go into the trust, becomes the trust property, and avoids, right, not part of the decedent's, right, not part of the grantor's estate. But as a revocable trust, yes, the transfer can remove items or add items to the trust. As a revocable trust, can also change the terms and conditions of it, and can even name new beneficiaries as a revocable trust. If we're an irrevocable trust, however, then can't. Yeah, then that's pretty much set in stone.
That kind of contradicts the question about 5 back, where it talks about the revocable trust taking the place of a will. Because that also had a question, or one of the answers was also about the estate taxes.
Let's see. Unfortunately, I can't go.
Wouldn't that be an irrevocable trust that has the purpose to avoid estate taxes for the grantor because they can't take it out?
Since by an irrevocable trust.
Irrevocable.
An irrevocable trust. Okay.
So the opposite.
Isn't it irrevocable once the person dies? Then it becomes irrevocable.
Well, I suppose it does. Yes. Okay. No, now I'm all turned twisted and turned around myself. Okay, because I don't think I can go backwards and see what the previous question said. So I might have to circle back to that to make sure. Okay. All right, but let's check out and see how we did. All right. In third place, bronze medalist is Amy, and in second place, silver medalist is Ashley, and first place, gold medal and Olympic champion. That's Alexis. Okay. All right, try this one first. Okay. All right, let me go ahead and pause the recording again. All right, and before we pick up for our remainder of the evening, let's go ahead and take another very well-deserved break. And let's return. I'm going to put this in the chat here. Return at, let's see, we got 17 past. Let's turn at 27 past the hour. Okay. All right, and I'll see you in just a few minutes. Thank you, Kimberly. Also, thank you. All right, so before we get to the next part of the quiz here, I'll bring this up. I'll share screen in a moment. But the question here says, does common stock have an inverse relationship on interest rates and prices, or is that only for preferred and bonds? Okay, there's a direct relationship between interest rates and fixed income investments like preferred stocks and like bonds. Not so much with common stocks. First off, common stocks don't have a fixed payment because if they pay a dividend, it's entirely up to the board of directors. It's not a fixed amount. Having said that, now there is influence about it. If interest rates rise, that tends to depress the stock market, partly because if interest rates rise, corporate profits may not be as high because they have to pay higher interest rates, but also because if interest rates go up, well, now bonds start to look more attractive, right? because you're always like a fund manager, right, or money manager is always deciding where to invest money, right? Where is it? Is it a risk we're taking? That's really what they're looking at. So if interest rates are rising and bonds have a higher yield, and bonds are safer than stocks, then if they have a higher interest rate, it becomes more attractive to put your money in bonds and not put as much money into stocks. So there is a relationship. It's just not a direct relationship. Karina, I hope that helps out. Good deal. All right, let's share the screen. Okay, a few more questions for you. This one having to do with account activities, okay, and the proceeds of accounts, procedures of accounts. All right, our first question here is, which of the following items is not needed to open a cash account? A, customer's name and address. B, customer's social security number or tax ID number. C, customer's signature. Or D, customer's occupation and employer. Let's see, 1, 2, 3, 4, 5, 6, 7. Okay, so most folks chose choice C, and you know what? I'm going to agree with you. I would say choice C is indeed the best choice. So a customer signature is not required to open a cash account, at least not according to regulators. We do need, of course, their full legal name, and we do need a street address, right? Not a P.O. box. We have to have their actual street address on file. We can mail to a P.O. box, but have to have the street address on file. We do have to have their social or tax ID number. Now, partly, of course, that's for 1099 forms, right? That's for tax reporting, but also partly because it's part of our customer identification procedure, right? To know that they are who they say they are. And we do ask for the occupation and employer. And one reason we ask is that because if someone works for another FINRA member firm, right, there's certain stipulations apply. If someone is an officer, director, or 10% shareholder of a publicly traded corporation or is an immediate family of one, that makes them, right, affiliates or insiders, and certain stipulations apply. Okay, but no, according to regulators, we do not need a customer signature on a cash account. We do need the principal signature who approved the account, though, not a customer signature. Okay, and by the way, in case you're thinking, okay, when is an occupation or not needed or type of account? They would be things like, let's see. I was about to say a trust account, but if the trust grantor or the trustee are insiders or work for another FINRA member, that could be needs to know too. For qualified accounts, again, if there's someone who works for another FINRA member firm, it just applies. About the only thing I could think of. I was about to say a custodian account because they're minors, okay, and probably don't have a job yet, but we may still need to know about the custodian. So at this moment, I'm hard pressed to think of a case where they would not need a occupation or employer. Okay, thanks, Karina. Okay, one of these I just reviewed, and it was just misread. Yeah, no, this one is badly written, so let me skip over that one. A customer calls his broker and says, I'm going on vacation for 2 weeks. Do whatever you think is necessary for my account. Which statement is true? A, the broker can exercise discretion in the account. B, the broker cannot exercise discretion in the account. C, the broker can only exercise discretion in the account if each trade is approved in advance by the branch manager. D, the broker can only exercise discretion in the account only if each trade is approved by the NYSE. Okay, that's 6 so far. Nope, that's 7. Okay, So a customer calls his broker. All right, notice as he calls, right? That means he called him on the phone and says, do whatever you think is necessary for my account. Well, in order to have discretion, to be of discretionary authority, the customer must give discretionary authority in writing, must give power of attorney to the registered representative to be able to exercise discretion. Is there no mention here of him writing out a form, right, filling out a power of attorney form, in which case the broker cannot exercise discretion. Choice B is best. Doesn't matter if it's approved by the branch manager, got to be in writing, and the New York Stock Exchange is not going to get involved. So that's just complete nonsense. Next question. Which of the following orders requires specific customer authorization? A. Customer's order to sell 100 shares of KO at the market. B. Customer orders to buy as much of GE at $40 during this trading day. C. Customer ordered to buy 100 shares of IBM at $125. D. Customer orders to sell 100 shares of GE when it gets to a certain level or lower. Okay, I've counted 6 answers. All right. Which of the following orders requires specific customer authorization? Now, you remember what requires authorization. You can remember that as the 3 A's. Okay, if the customer provides all 3 A's in an order, it does not require their specific authorization. It's not considered discretionary. Does not have to be authorized. The 3 A's are, of course, the asset, right? The specific stock they want to trade, the amount, whether it's dollar amount or number of shares, or action, buy or sell. One of these does not provide all 3 A's, and that is choice B. By GE, there's a specific asset. Okay. Okay, said to buy, there's the action, but it didn't say a specific number. Buy as much as $40 as you can is not a specific number. So therefore, that is considered to be discretionary, and that must be in writing. All the others, the asset, the action, and the amount, are all there. Even choice D, right? When it gets to a certain level or lower, that's called a stop order, a sell stop order. If it goes down to this price, sell. Okay, does anyone have a question? Because I noticed there was some difference of opinion on this one. Okay. Asset, amount, and action. Choice B did not have a specific amount, whether it's dollars or number of shares. Yeah, by the way, they don't have to give the price, right? The price, that's called the price and time exception. So if they can let their registered rep use their judgment when they think the price is right. So they'll let them do that. It's called a not held order or market not held order. The firm is not held to price and time of execution. They'll let them use their judgment to see if they think they can hold out for a better price. An 80-year-old customer with an existing individual account comes into a branch office and tells the representative that my son has been telling me that I need to give him power of attorney over my account because of my advanced age, and I want to keep him happy and keep him from putting me in a retirement home. What should the representative do? A. The representative should give the customer a power of attorney form, naming the son as attorney over the account and having the customer sign the form. B. The representative should contact the son and get permission to have the customer sign a power of attorney. C. The representative should escalate the matter to the branch manager or compliance department of the firm. Or D. The representative should freeze the account until it can be determined that the customer is not mentally incapacitated. That's kind of harsh sounding, isn't it? Okay, everyone's answered this one. Okay, so what we have is this situation here. Okay, so many have answered D, that the account should freeze the account until they can determine he's not mentally incapacitated. Now, we may have, of course, customers who are, let's say, suffering under the effects of dementia or Alzheimer's. And if we talk to our customer and they seem to be well out of it, then we should escalate that to a supervisor. But no, we do not need to freeze the account. The only time we would freeze the account if we suspect financial exploitation. And that's the case in that case to determine is any financial exploitation going on. And they place an initial hold for up to 15 business days. In this case, well, I'm not sure in this case if we're looking at a case of a dementia patient or if we're looking at the case of possible financial exploitation. Right? Is his son threatening him that if you don't give me your money, I'm going to put you in home? Well, I'm not sure which, but but in this case, we are going to escalate this one. We're going to give this one to the manager or compliance department, compliance officer. Okay, we're going to tell them what we know and let them check it out. So our best answer choice will be C. Okay, now we got next here. Okay, that was on this chapter. Our next chapter here is Regulation T applies to a transaction in all the following securities except A, U.S. government bonds, B, American depository receipts, C, warrants, D, convertible corporate bonds. Okay. I've got 6. So Reg T applies to all transactions. Remember, Regulation T is the one that that's the Federal Reserve set the minimum margin requirement. It does not, however, apply to exempt securities, right? The ones that are exempt from registering with the SEC. And which is exempt from registering with the SEC? U.S. government bonds, correct. So this Reg T does not apply. All the other 3 are corporate securities. Reg T applies, right? And those securities are not exempt from registration. So they're not exempt from Reg T requirements either. A customer buys securities without making payment and then sells the same securities without showing the intent to settle the transaction. This is A, free riding, B, front running, C, interpositioning, or D, backing away. All right, so what do we call this transaction here, right? Customer buys the security, sells it, and doesn't settle the transaction, which means they don't pay for their trade. They don't deposit a check in the required time, right? Should be T plus 2, can be extended to T plus 4. And that is a violation known as free riding. Okay, that's basically profiting without paying and just basically using the house's money without having your own skin in the game. Yeah, they call that free riding. Yes, okay, that was a great song by the Edgar Winter Group, but it's a violation in here. Does anybody pick up that reference to the Edgar Winter Group? Anyone remember that song? No? Either thumbs down, you either don't know the song or you hated the song. Which is it? Free Bird. Yeah, well, that's Leonard Skinner. Okay, class dismissed. Your homework assignment is go listen to. Okay. All right, good. Okay. So anyway, yeah, this is called free riding, and it is profiting without paying. By the way, when I worked as a rep, people would blow up their own accounts all the time. They'd buy it on Monday and sell it on Tuesday, and figure, oh well, if I sold on Tuesday, there's at a profit, right? Well, there's your money from your trade, and there's a little something extra for me. but not without realizing that they still have to pay for their trade. They cannot trade just using the house's money and not have their own money into it. Front running is sticking your trade in ahead of a customer's trade. Figuring if they're going to do a big block trade, it's big enough to move the market. You figure, oh, well, I'll stick my order in first and then I'll let it move the market and I'll get out. No, customer orders must be fulfilled ahead of time. Interpositioning is sticking another firm or another trader in ahead of with the customer's order, which often results maybe in additional fees or expenses or commissions. It can only be allowed if it basically arrives and it allows a better execution for the customer. Backing away applies to firms that are market makers, they're dealers in securities. When they make a market, they have to pick a two-sided quote, the price they'll buy it for and the price they'll sell it for, a bid and an ask price. And they're expected to honor that quote. Well, making a firm commitment quote and not honoring it is a violation called backing away. Okay. A minor can open which of the following accounts? A, custodial account. B, a joint account with rights to survivorship. C, UGMA account. Or D, a minor cannot open an account. Okay, I think we need one more. Okay, I think we're good then. All right. Best answer choice, a minor can open which of the following accounts? Yeah, watch out for the wording on the account, on the questions. They're trying to trick you. They're trying to catch you off guard. Minors cannot open an account. Okay, someone who is of legal age can open a custodial account or under Uniform Gift to Minors Act on behalf of a minor, but minors are not of legal age to enter into a contract. So, and of course, can't be in a joint account either because, again, not of legal age. So, minor cannot open the account is the best answer. Okay, but yeah, this one was trying to trick you. All right.
Isn't there, I mean, a lot of times though, parents have checking accounts with their 16 or 17-year-olds.
Maybe so. It might be, well, first off, these aren't banking rules, but these.
Oh, that's true.
Yeah,
yep. Never mind. That's what got me flipped.
It's probably still their parents, really the parents' property. They just give their kids check writing authority on it. Okay. Let's see. Okay, Google. Play Free Ride by Edgar Winter Group on YouTube Music.
Okay, Free Ride by the Edgar Winter Group.
Let's see.
On YouTube Music.
Let's see if we can hear it from here. I'm not sure if we can. It's got to play a commercial first. Oh, anyway, that wraps up our today's session. Okay, so we're a little bit. Hey, what? Can you hear it? Yeah. All right. Mountain is high, the valley is low, and you're confused about which way to go. Anyway, that wraps things up for today's session. We'll see you again on Wednesday, and we've got two guest speakers coming in on Wednesday to talk about career opportunities. All right, I think you'll really like to see those career opportunities. Well, a pleasure, folks. We'll see you again soon. Take care. We'll see you again later. Bye-bye, folks. Oh, sorry. Someone had a raised hand. Oh, someone's hand was raised.
Yes, I just had a quick just question for you.
Yes, it's a great question. Okay, Google, pause. Okay, sorry about that.
No, you're good. Okay, so pretty much I took these courses for my work pretty much, and I was under the impression for like a lot of this, like the beginning of this all was to get prepared for the exam and then later on take the exam. But I later realized that this class does revolve around taking the exam in December. And I'm just like, I just would prefer to like get a little bit more on top of the subject at hand. And
Mhm.
I'm just not sure if that even is possible. And it just, I don't know whether I should just go ahead and do my best and just take this exam and get like, even if I don't pass, it's more of like a learning curve and just to get familiarized with it. But I just wanted to like, in a sense, to even get more prepared. And that was my plan originally, but I just see it as it's not going to be possible. I mean, in general, this class is to just prepare me and like
Mhm.
my employer is not looking at the grade that I get from these classes. It's more if I pass the exam.
Mhm.
So I'm just kind of conflicted on how I should go about this. Like I can't take the exam, and if I don't pass, I can take it again. But I just don't know if that would be like something that you advise.
Okay, so first off, I'm making a note to myself to contact Bill Wingard at SEC. I want to make sure about what the rules are and stuff. Okay,
Yeah,
so you'd prefer to take it later than December, basically, right?
I would hope just I mean I just because like my plan from like a lot of this like as of right now like I wanted to like get all the material, be more exposed for it, and then I'm like creating like flashcards right now to like start cranking down and really like testing my limits, and then after that taking a lot of like more like repeating the tests that we have on Past Perfect. But I just feel like if I mean it just I just was kind of thrown off in a sense for this class. I wasn't aware. Like I just was thrown into the class by my employer.
Oh,
So I just don't know. I don't know how to really go about it. Again, like either way, I feel like it could be done, but I just don't know what you would advise.
well, my own suggestion, not entirely, of course, you got to figure out what's best for you, of course, but my suggestion would actually be to at least try to take the test in December. as
Okay.
as the class is kind of intended to do, get you all prepared up and revved up in as quick a time as possible, and be ready for the actual test in December. Now, look, as I said, hey, if you don't pass the test on the first try, all right, it's only a 30-day wait to take it again, and that's plenty of time to get yourself fully revved up and up to speed. But hey, you may have done well enough between now and then to be able to pass the test on your first try.
Yeah. Yeah. So I think it wouldn't hurt for me to just go ahead and take it.
Mhm.
Just to be exposed by it. But yeah, I was just wondering if there even is like a later date. But I just thought I would just ask that question
Yeah,
since we're here.
I'll confirm with Bill, and I'll see what he's got to say.
Okay, thank you so much, Professor. I do appreciate it.
Oh, it's my pleasure. Have a
Yeah,
great one. Okay,
bye bye.
bye.